Okay, so let's begin. Our topic right now is analytical content for the crypto economy. And let's begin with some short introductions. So my name is Anton Sotnikov. I work at LATOKEN. I'm an analyst, mostly do research analysis and like product research. Um,
So my name is Mikhail Mironov. I come from ICORating. First of all, I'd like to ask the audience, how many of you know ICORating or read our reports? Cool. Good to see that. So our business model, we run the independent rating agency for the ICOs. Today I want to touch base on, the conflict of interest, how we try to avoid it, and the whole business model and our methodology. So thanks for being here.
Hi everyone, my name is Tone Vase. I'm a content creator in the space with a YouTube channel, pretty popular Twitter handle. I come from traditional Wall Street environment and been around the cryptocurrency space since 2013, writing and making videos since 2014. One of my more popular podcasts is called Crypto Scam, where I try to provide some of the details around a lot of these projects, focusing on the big boys like Ripple and Ethereum.
Hi guys, I'm Bobby from CoinGecko, the co-founder of CoinGecko. Similar to Tone, I got in around 2013. We've known each other for several years now. So CoinGecko is a cryptocurrency data website. We track over 1,000 cryptocurrency. We track the price, the market capitalization, trading volume, and they also track statistics surrounding the development of the coin on GitHub and then on community on the Facebook, Twitter, Reddit of the coin. So that's what we do. And we track an ICO calendar on CoinGecko as well. And pretty much that's what we've been around from 2014, and we are the second largest site after CoinMarketCap. We do about 100 million page views per month.
all right, so the first question is about the role of analytical content in promotion and development of the blockchain economy. Can you share some insights?
Yeah, so I'll start with CoinGecko. So we started 2014. Back then, there weren't that many coins out there in the market, so we were all small-time traders. We were buying and selling coins. What got us really annoyed was that back then, people were just saying that my coin has the best community, my coin has the best development team and all, but what really annoyed us was people were just saying it qualitatively without putting these statements into numbers and all. People were not comparing the stats quantitatively. So what we decided to do was set up a site and start collecting all this data to start saying, okay, you have how many Facebook likes, how many Twitter followers, how many Reddit followers, how many commits and stars that you have on GitHub. Put them all together and rank crypto projects. But of course, back then, there wasn't any ICO hype. Like people were just buying these coins and trading projects that are already on exchanges. So once we came out of there, we decided that let's rank these coins on an alternative ranking index. Because back then, a lot of these small coins, they have small market caps, really easy to manipulate those market caps. And with these other stats that we have on a CoinGecko, it becomes harder to manipulate when we have an alternative ranking index. And now the ICO booms really started around mid-20s, around 2017. And now we want to start doing the same thing on the ICO section as well.
What was the question?
The question was about the role of analytical content in the promotion of blockchain economy.
People try to write I'm about to really piss off my panelists here. So people try to write these kinds of reports on these ICOs, and they're all writing these giant white papers. Honestly, I'm really mad at Satoshi. He ruined the term white paper for the rest of history. A white paper was not that of a common thing. It was basically a scientific paper introducing an idea. And now a white paper is a pitch deck. That's where a white paper is now. It's a pitch deck. I've seen these things up to 40, 50 pages. I remember when the Steemit white paper came out, and I read the first page, and the cover page, not even the first page. I read the cover page. and where it says, steam it and whatever they claimed it was on the front page. And then right under that was the authors of that paper, and the first name I see is Dan Larimer. And I say, well, it's as far as I need to read. It's over. Like, this is a scam. That's all I had to do was read the word Dan Larimer. I didn't have to read the 44 pages. It was over. Because a lot of people don't remember, but back in early 2013, not even that, I think early 2011, Satoshi Nakamoto personally told Dan Larimer, if you don't understand this and don't get it, I no longer have the time to explain this to you. That was Satoshi talking to Dan Larimer. And I swore I would read the entire 44 pages and then tweet out every page and point out why Steemit is a scam on every page. And I was able to successfully do that. The hypermarked 44 pages are posted on my website, along with a big article about Steemit. And I did a couple of other white papers just like that, and I still haven't seen one that is borderline legit. So I've completely given up on looking at any of these ICOs. And now I focus on the big boys like Ethereum and Ripple and anything else that's, the bigger it is, the more painful it's going to be because there's no development underneath, there's no technology underneath. People really have to realize who is programming these things. I haven't seen anything, honestly. All right, I'll move on.
Yeah, thanks. I think that's a very valid point. And, we see not only white papers, but yellow papers, golden papers this year. They like to call them, instead of yellow, golden. Well, probably next year we're going to see the silver paper and things like that. So at ICORating, we evaluate them. We read them from the first page to the last. And, the content varies. We all know Bancor had like 6 pages, I think, with a really bad explanation of their business model. So nevertheless, they attracted more than 100 million investments. So yeah, the content is important, and the white papers, in many cases resemble scam, of course. But sometimes I think it's not a scam, it's just a terrible preparation for the ICO.
Yeah, all right, so I want to follow up on the ICO evaluation. The question is basically how to assess ICO projects, because CoinGecko at ICORating, and Anton, I think you also sometimes do videos on ICO projects. So how to assess ICO projects?
Yeah, thank you. So first, I'd like to talk about the business model of the rating agency, and how to avoid the conflict of interest. And because it's a controversial point. So many people come up to me at this conference, funds, individual investors, and they all ask us, so how do you do that? So you guys probably know that S&P, you probably know S&P, Fitch, and Moody's. How many of you read their report at least once in your lifetime? Great, I think there are 2 people. So I used to read a lot of reports from Moody's, S&P, and Fitch in my banking career. So you can use them as a basis, and probably you know that S&P, it's the oldest rating agency, and they appeared, on the wave of industrial revolution in the US and the railway revolution, more or less. So our rating agency, we exist more than 1.5 years, and we appeared actually on the wave, at the midst of a blockchain revolution. And, on the one hand, rating agencies are being paid by the client, and that sparks controversy. So we are paid by the client to rate them. But on the other hand, investors read our report. So from 2003 to 2008, Wall Street underwrote more than $3 trillion for subprime, and they were all rated by Fitch, S&P, and Moody's. We all know what happened. First of all, it seemed that the rating agencies didn't understand, the product. The banks that they were buying subprime mortgages didn't understand their rating, and we know what happened. Lehman Brothers collapsed. The bank I worked at, Fortis and ABN AMRO, collapsed just because of that. And we got the financial crisis. So on the one hand, like one side of the coin, how to be independent. Like if your client pays you, imagine the legal system where the judge is paid by the client. So how do you like that? But on the other hand, there is a reputation of the rating agency. So our reports are being read by increasing number of crypto funds, by increasing number of high net worth individuals. We are being called by family offices. So it's our reputation is at stake. So imagine if somebody invests in the project and the risks we specify there, you know, they're not truthful. It's a really noble role of the rating agency to serve both investor and the project. So coming back to, sorry if I hijack the, you know, the entire conversation, because it's about, you know, like how we assess that and, you know, the rating methodology. So we developed the methodology for, you know, longer than 1 year ago, and you know, before the ICO explosion, our team of analysts consists of all the guys with investment banking background, with a focus on the technology. So we developed a pretty solid evaluation model. It focuses on two things. We look at the project through the lens of the VC, you know, the traditional way how you evaluate startups. And on the other hand, the other side of the coin is that we look at the technology, how the whole blockchain, you know, fits into the project. There are so many startups here that pitch, and you wonder, what's the role of blockchain in there? How you justify that? We also focus in our quantitative evaluation on the economics of the token. How, yeah, I mentioned already how it fits into blockchain space. And, you know, the ICO structure, this year, we see increasingly the better quality of the project. The lockup periods for the tokens are getting longer. Like, for example, V-Power, the ICO'd on the 1st of February, 30 million were underwritten by the funds with a lockup period for their bonuses. It's quite as far as I remember, like 6 months. But the team locked up their tokens for 3 years. Legolas exchanged, they ICO'd on the same day. They have a lockup period for their team of 18 months. So we like that, and we like to see the financial plan in the in the white paper, or, you know, like in the pitch book, how this company is going to develop the project year by year, quarter by quarter. How are they going to spend the tokens they raised? And at the end of the day, we also like the escrow service. So the release of the funds upon the completion of a certain stage they specified at the roadmap.
I'll continue from there. I mean, I was also the big casualty of the 2008 financial crisis. I was at Bear Stearns at the time. And yeah, the S&P, the Moody's, and Fitch, they all were not able to evaluate subprime. The reason they weren't able to properly rate subprime is because all of it was pure garbage. So no matter how they rated it, it wasn't going to work. It was this idea, the whole idea that this, the subprime lending was legit and that real estate can never go down. I see the same exact thing here with the ICOs. It's this whole idea that the 100 years of laws that came about from people trying to solicit money from unqualified investors gave us a certain set of rules that you have to follow to go IPO in order for unqualified investors to invest in your project. Now, it's very simple. What makes an unqualified investor from a qualified investor? How much money they have. That's basically the only criteria. Now, on average, a qualified investor with more money is, on average, generally smarter than the unqualified investor because they would have earned that money somehow up to that point, taking outliers of trust funds aside. And in addition, a qualified investor has the resources to hold the person they're giving money to accountable for when they don't go through with their promises. So the way I evaluate all of these ICOs is fairly simple. The first question I ask is, why do you need a token? And why does your company, for which the product you're creating I still don't understand, deserves $200 million, and you think it's worth $200 million. And 90% of the time, the token is not needed. A little while ago, the big thing was, well, we need application tokens. You have to use our token to use our product. And my answer to that was, really, how come Amazon hasn't figured that out yet? How come they're not charging me in Amazon stock? How come Delta doesn't charge Delta miles as the only currency to buy their airline tickets? You know, and on top of that, how come Delta miles aren't volatile on anonymous exchanges being traded by 13-year-olds being pumped and dumped through chat groups, right? So 90% of the time, the token itself isn't necessary. The token is just for the company to get money because everybody wants to get money from other people so they can build their ideas. Now, the ideas of all these projects are totally debatable. I mean, I personally think they're not that great, but that's completely debatable. What's not debatable is a blockchain was created by Satoshi Nakamoto to get around regulation. But it doesn't work when you have a CEO promoting your company. This is why Satoshi was always invisible. This is why he disappeared. This is why Bitcoin grew to what it is. And that model doesn't really work. The other question I ask when I try to evaluate these projects is, why do you need a blockchain? And what is a blockchain to you? Because the definition of a blockchain is very, very different from different people. On the one side, it's a sliding scale. On the one side, you have the proof of work protocol with an immutable transactions digitally that allows me to accidentally permanently delete all the money I have because it's all sitting in Bitcoin. And I can accidentally permanently delete that. That's one side of the blockchain. The other side of the blockchain is an Excel document posted as a Google Doc. That's what most people refer to as a blockchain. Just a Google Doc that multiple people can edit. So where on the sliding scale are you for using a blockchain? And you'll realize that in 99% of the cases, it's just a database. There's nothing immutable about this thing. And the same thing with the lockup. Like, it doesn't matter what they tell you. Our funds are locked up. No, they're not. There's no immutability there. You can walk away with those funds anytime you like. And that's another problem that I see. Like, and what is your security? Who are your engineers? How are you, with these funds come in, what qualifies you to hold on to other people's money? Because you can be hacked. And are you going to be held responsible for it? I hope more people get held responsible for when they get hacked. Maybe they'll be more careful about taking money from other people.
So yeah, it's a question of how do we evaluate ICO. So I have my personal opinion and what CoinGecko does. So CoinGecko, I hold a view that first, when I look at ICO projects, I generally look at the idea. Like, is the idea interesting? But most importantly, do you need a blockchain for your idea? Most of the ICOs that I see, like, it's just rubbish. They're just creating a token for the sake of doing an ICO and raising money. And of course, like, these guys, they write their white paper and all about explaining their ideas. It's very subjective. Different people view it differently on how this project can be useful or not useful in the blockchain space. And also, at CoinGecko, in that point of view, we don't really want to have a subjective point of view on this white paper. So what we want to do is we just really want to collect like hard quantitative facts, like data where it's out there in the market, like how many Telegram users, how many Facebook likes, and all. These are facts that you cannot manipulate. We have no subjective view of a project or item. So from personal opinion as well, how I evaluate projects, the second thing that I look at, besides whether the idea is good or do you need a blockchain in the project, is the team. Is the team solid? Do they have some crypto? You are raising money from the crypto economy. Like, you should have some sort of crypto experience. Like, the real world fundraising process and the crypto fundraising process is sort of different. Like, things don't really work the way. A lot of people are in it for the short term. They just buy the funds, and then the questions that you hear from crypto investors, like, which exchange will these tokens be listed on? Because all they care about is dumping the tokens on Binance once it's listed on that. Yeah, so, and then we look at the team, like, is the teams, do they have some real world experience? Are they like some group of 3 or 4 like young crypto guys just doing a project, raising like a lot of money, you know? Or do they have like real world experience? Do they work in like large companies before they do their projects? Another thing that we personally look at is a hard cap. Why on earth do you need to raise an ICO for $50, $80, $100 million when you can just raise $1 million or less than that? seed investors just give like $500,000 for you to run your startup and all. That will last you 18 months. Why are we giving like $20, $30 million, $50 million to a lot of people out there to do an ICO project? And a lot of circles and investors that we invest that invest in, like $10 million is more than sufficient to raise an ICO. 10 to 20 million is medium size. Anything above $20 million is a lot of money. And last thing is partnerships. Like a lot of these, we look at partnerships. Do these guys have partnerships with government, with large corporations and all? If you can't even have a partnership or work out there, then we're probably not trying hard enough. Of course, having a working prototype is a plus point. In fact, you should be having a prototype or MVP before you have an ICO.
Yeah, one last point. If anyone is, if there's any company out there that actually has an idea that's creating them revenue, why are they ICOing?
Well, I want to add to this. I think, like, I agree with some points that Tony and Bob mentioned, but at the same time, I think it's pretty harsh, like to say that 99% of ICOs are not legit. Because there are plenty of the guys that want to solve a specific problem, and like we distinguish in our rating methodology, infrastructure products from dApps, and it's a totally different evaluation. So we need decentralized exchanges. The question is, do we need to how the whole system is being implemented and the economics of the token, and at the same time, look. If we think about the railway, again, maybe I repeat myself, the railway revolution in the US in the 19th century, nobody knew how to evaluate those companies. It was an explosion. So how do you deal with that? All those new companies, all those new standards. We need these standards to evaluate those guys. And for example, if Telegram wants to raise 500 million during the pre-sale and 1 billion on the public sale. If you compare it to Cardano, that has evaluation, well, I don't know the evaluation right now, but it used to have like more than 1 billion, and Telegram has more than 350 million active users, So if you do your math, sometimes it makes sense. So, and coming back to the methodology, you guys mentioned, the team, the partnerships, the MVP. We all have it. We have it all in our methodology in a structured way. You can go to our website. There is a section within methodology how we calculate risk, how we calculate hype, and then the quantitative and the qualitative parts of it. So, what you mentioned, we have that.
Look, so what everyone that comes to these events, especially an event like this. What everyone is realizing is this is what VCs deal with on a daily basis, right? So you are now being convinced that VCs are all these rich people that are becoming richer, and anyone should have the ability to invest in any project. But in reality, there's a little problem with that because even VCs basically get lucky with projects, right? Like, who saw Facebook was going to dominate and destroy MySpace and Friendster? And there was lots of other competition. And the answer is no one. I mean, the VCs also get lucky. And if you invested your money across all of these social media platforms, you probably would have still lost more than you gained because then you still don't know when to get out. So this model of investing in companies and technology that you probably don't understand is specifically designed for people that have the money to lose. What's happening right now is people are doubling down and doubling down and doubling down until it pretty much ends like the dot-com crisis, which wasn't even that bad, right? Like, it didn't affect the overall economy, it just affected the tech economy, but it all, came back. So I'm just here to like inform people that this is the world that they're living in, and very few people have the ability to assess these companies. So unless you're planning to invest in all of them, and the next conference you go to, you will see a whole new list of 50 companies, and in 12 months, none of these companies you'll probably hear from again, because this is the space you're in. And this is why people that are experts in investing do it because they enjoy it and that's their job. Okay, just a little warning.
I guess the last add-on to this one. So yes, a lot of people are investing in ICOs for the reason of like pump. They put their money, they expect the pump, and they unload their investment. But what we see increasingly in the ICO space, and those we see that you mentioned, sliding into ICO space, and they want to invest for long term. They increasingly have teams of analysts, like 3, 5, 10, guys with a computer science background, guys with a financial background, guys who worked in reputable banks. So they all sit down, they have their credit committee of the investment committee, they do understand the white paper if it's good, they invest in very little projects, and in our reports we give the long-term outlook on this investment. You know, and if it's risky, it's risky. You know, it can be dumped. And if it's positive, you know, there is a correlation in our study. Please check out the annual report, the industry report that's going to be released next week, so you can see how ICOs perform post listing on Binance, HitBTC, and so on. So this, again, I want to repeat myself. We have a lot of funds that use our reports that want to invest for 1 year, for 1.5, and so on. They go into partnerships with a project, and they want to help them, just like VC. They want to help them grow. 2017 was a different year. You know, so many ICOs didn't have the knowledge. They didn't have those mentors like the VC can provide in the Silicon Valley. You know, I used to work for Airbnb, and for example, there were a lot of coaches, you know, involved that VC provided them, and we see it now increasingly in ICO space. So, you know, even if 99% will die at some point, you know, we will have 1% of great projects.
Like, it's hard for me to imagine like real VCs going into the space, because the big difference between traditional VC investing and ICO investing is in traditional investing, a VC can hold that project accountable. You can't do that in this space. You cannot hold the project accountable. God knows how much, well, even when Ethereum collected all of that money by selling what I consider an unlicensed, unregistered security, a year before it even existed, nobody was holding that team accountable to launch anything. They could have just walked away with that money and disappeared, okay? That's not as common or almost non-existent, because traditional VCs expect something in return. That's why traditional VC still isn't going to go anywhere with this. But the hype bubble grows, and there's not enough data to kind of say that, oh, ICOs are doing great. No, you're in the middle of a hype bubble. Can it last another 3 years? Yes, it can. Can it end tomorrow? Yes, it can do that as well, okay? But those are the big difference. And I'm going to quote Alex Marcos here, one of the very respected core developers, where he said the big difference between all of these ICOs and traditional companies is that when you start a company and your company fails, the person that started that company should not be able to walk away insanely rich. And that's what we've seen from this space. And all they do is leave a project and start the next project. That's what I've seen anyway.
Yeah, what I'm observing as well is that it's usually the same guys raise an ICO, a few months later, rinse and repeat, do a different ICO, and what we're seeing as well is like the same group of guys like advising 10, 20 different ICOs. Like, I mean, how do you really advise so many ICOs? All they're doing is just taking the tokens, and most of these ICOs have no lockup. Take the tokens, hit an exchange, dump everything, crash the price, move on to the next project, rinse and repeat. Go for conference, find an ICO, get into the pre-sale, get some discounts, hit an exchange, dump. And one of the things that we've been observing in the crypto space, and it's not something new, we've seen this from like 2013, 2014, like every project that is launched in the blockchain space has high, lofty, grand vision of what it will do. It has milestones, Q1, Q2, Q3, Q4, year 2, year 3. But the thing is, a lot of these projects, they just don't deliver. Like, they say this grand vision, after 3 months or 6 months, this whole team disbanded and just disappeared. And then you have the case of Tezos, who raised so much, $100 over million, and then the founders just ran away, and there's a class action lawsuit. Everyone who invested in it have their funds tied up and stuck now.
Yeah, and now what the VCs are enjoying right now is they can exit so much earlier, right? So it's good for them. The moment, I mean, it's great. You do your pre-ICO, you sell it to a bunch of influential people. I mean, I get like a dozen of these emails a day in my inbox. And you sell your pre-ICO to a bunch of influential people that help you get the valuation high. You immediately exit the moment the coin goes to an anonymous exchange. I mean, one of the fuels that's driving this whole thing, and when I talk about this kind of presentation, comparing ICOs to IPOs, one of the things that drove the dot-com bubble to these insane valuations of, you know, a dot-com, no developer, no product, no revenue, but the stock's trading at $100. One of the things that did that is companies like E-Trade and Scottrade, where all of a sudden, your taxi driver, your barber, your shoe salesman had the ability to become a trader. And that significantly helped drive. I mean, I remember I was in college, and like my one of the guys in my dorm was like trading penny stocks. You know, he borrowed $1,000 from his older brother, and he's like trading penny stocks. We're like 18, 19 years old. Prior to the 90s, when these dot-com brokers came out, that was impossible, right? I mean, you go back to the movies like Boiler Room and all the other ones. I mean, you had these stockbrokers that had a call list. So they would call and solicit people. Now, they were supposed to only call qualified investors. So people with some money. Of course, they were breaking those laws, and they were, you know, they didn't care who they sold to. But your shoe salesman didn't have a way to trade, you know, penny stocks, didn't have a way to trade any kind of NASDAQ. He did. But there were still some requirements. You still needed to be a citizen of that country. So to trade the US NASDAQ stocks, you needed to be affiliated with America or in a country that allowed you to trade that. You still needed to have a bank account. You needed to have a social security number. And if you wanted to be a pattern day trader, that's the 3-day settlement rule, you needed to have at least $25,000 in your account. So there was still some kind of a minimum barrier to entry. That barrier to entry is completely disappeared in the crypto space, right? There's absolutely no age requirements. I've personally spoken with 12 and 13-year-olds that are now active and professional traders. There's absolutely no minimum financial requirement, right? $100 and off you go, start trading. There's absolutely no jurisdictional requirement, right? I mean, these things are completely global. And this is one of those things where you have a flood of people that have no idea what they're doing, trading this stuff, and how big can they pump it? We'll find out.
Yeah, what we find really funny is there's so many guys out there calling themselves crypto god, crypto deva, like crypto experts, and all these guys, they just go into crypto space like 3 months ago, and like they was lucky to buy Bitcoin was like, I don't know, back in 3 months ago, probably $8,000. It went up to $19,000, and suddenly they are, I'm the best crypto expert around town, you know. I guess they're all quiet now, like since price has gone down. But yeah, and then talking about like the team, the lockup periods for team, like it's kind of ridiculous. Like all this, like people doing ICOs, they are doing it for themselves. There's no lockup period for team. Mikhail brought a point where the team now has 18 months lockup. 3 years. 18 months, that 3 years.
Who's holding them accountable? Who audits the code? What makes it immutable? Like, is it sitting in a, you know, Bitcoin barely has the capability to lock up your funds for 3 years. Like how is this being enforced?
Can I say that? So first of all, there are smart contracts, and increasingly, these companies are using the escrow agents. You know, you need 2, 3, 4 signatures to release the funds. So, you know, it's and it's going to be increasingly used by good projects. And what I want to add here, look at the IPOs. You know, like big guys like Goldman, they underwrite IPOs. They have the lockup period for the shares that they keep in their pockets. Look what happens afterwards. How, you know, like companies like in China, Sina, Baidu, what else, Ren, you know, everybody knows it goes up after the IPO. The lockup period for the guys finishes, and it's dumped. You know, so it's very comparable. Remember Facebook when it went public? It was just going down for the whole year. So you can compare it with the ICOs right now. Okay, it's a totally different structure. But what we see, the VCs that are sliding into the ICOs, you know, they want this project to come to their incubator and help them.
So This was a problem in the late 90s. It's not really a problem anymore. In the fact, by the time your company goes IPO, that company is fully legit. That doesn't happen in this space, right? Like when you go IPO, that's the secondary market to unqualified investors. That should be the equivalent of your token hitting the exchanges. But that happens in the space almost immediately. But today, when a company goes IPO, it's very legit. Yeah, Facebook lost 50% of its value over the next 2 to 3 months because the Facebook IPO was so hyped. Again, so yeah, it lost and I told people not to buy the Facebook IPO, just wait, it's going to drop 50%. I said the same exact thing for GoPro. It's just pretty obvious because they get overhyped and they fall. But the difference is, you're right, like a company like GoPro usually goes IPO for the people to exit, right? When there was enough competitors of GoPro, same thing with Snapchat. I mean, they don't really have much revenue. So yes, you're right. The companies do go IPO when it's time for the insiders to exit. The difference is that company is known, that company is legit, that company has a stature in the world before most companies go IPO.
So back to the lockup period, I'm very glad that the space has evolved. I mean, 1 year ago, there was no lockup period for the team, so things are getting better from 1 year, 18 months, 3 years. But if you look at a standard venture-funded startup, like standard lockup period is 1 year cliff over 4 years, 4 years vesting period. 4 years vesting period, 1 year cliff. I think as we move forward to the ICO ecosystem, I think more and more projects should move towards this project. 4 years vesting period, 1 year cliff. I used to meet projects where the teams tell me, Bobby, it's so great, like we have a lockup period for the team. There's a 1 year lockup period and vesting throughout the whole 12 months. I say, wow, that's great, yeah. Like normal VC projects have like 4 years vesting period and you have 1 year and you tell me it's a good thing. So it's definitely better, like projects with lockup periods for the team is a lot better. Things are improving in the space. It was kind of ridiculous like 6 months ago when all ICO projects have no lockup period for the team.
So on a point of being accountable, actually, you know, we expect this year more and more file suits like BitConnect. You know, everybody knew it's a Ponzi scheme. So what happens right now? There is a file suit in a court of state Florida, and not only the guys from BitConnect that try, you know, like they want to be the guys who filed this suit, they want them to be prosecuted, but also the guys who ran the YouTube channel, you know, those teenagers who didn't even know what the cold storage was. So we expect more and more and more of these file suits together with increasing better regulations, better standards. So you got to be very careful, and us as the rating agency, obviously doing this evaluation, we are, you know, setting the standards and trying to be more and more, you know, prudent in our assessment. So they're going to be prosecuted, I think, many not legit and scammy projects. Let's just see 2018, how it's going to play out.
Yeah, okay, so I feel like we're running out of time, so maybe we should do some questions from the audience. Anybody has a question? Okay.
So my name is Mike Davey from DataStreamX. We're a VC-backed company, started 2014, did a seed round, and then we are doing an ICO right now, and also has got a term sheet for Series A at the same time. So my question to you in the middle tone, that you sort of were really negative on that, saying that if you have revenue and you are VC-backed and you continue to get VC backing, that you shouldn't do an ICO. Can you explain some of the reasoning behind that, why we shouldn't?
Oh, hold on to that, Mike. You're doing ICO, correct?
Yes.
Where are you based? Where's your company?
We're a Singapore-based company.
You're a Singapore-based company, and who are you selling your ICO tokens to?
It would be within the network. Our idea would be to, how do I say? Obviously, it's going to be going to people who are investing in ICOs and that. There are different groups and whales and other crypto funds who are coming in, so they're looking at it from that side. We are looking mostly on the private side, not going full public as the trend is.
So as an American, someone with American passport, are they able to buy one of your ICO tokens from the presale?
So according to our lawyer, that has to be an accredited investor, and that's written in the contracts there, that they'd have to be an accredited investor to join.
Right, so he can't buy into the pre-ICO, right? He's not able to do that.
They'd be what we say, their private sale. They are able to if they're an accredited investor.
Okay, but how soon do you expect to be trading on an anonymous exchange like a Poloniex or a Bittrex?
We can't publicly talk about that because that would be speculation on being on an exchange and having a tradable token.
Right, but it will probably be tradable immediately the moment you actually launch.
Once again, can't discuss publicly regarding being on exchanges because then.
But that's what's happened everywhere else, right? So the moment you do that, your token is now being traded not only by Americans but also 13-year-olds. So I don't understand how that model makes sense. Why would any company with revenue take that kind of a risk because you have no idea what the future regulation is going to be?
Well, that's a good point regarding being on the exchanges and that. But in terms of the usage of our token and with our users, and we are a B2B platform, we're not a B2C. The people who use we're a data marketplace. We help companies transact data, and that's where the token is going to be used within it. And so I wouldn't want to speculate currently in a.
But that's what I mean. I mean, this is a great model for a company that has absolutely no revenue, has absolutely nothing to lose. When you actually have a company with revenue and employees, and the company can make money without speculation by completely unqualified investors in a non-regulated market, I don't understand why a company would want to do that other than they feel that their idea is worth $800 million. And for some reason, VCs haven't figured that out.
So when you're looking at the people who are investing in, people who are approaching us, they actually usually understand a little bit what we're doing. We're not just randomly going out and shooting blanks in the dark looking for the public advertising on Facebook. We're doing a little bit, yeah. So like your point is that you're saying that everybody invests in ICO has no idea anything about the tech, right? That's what your point there was, that the people are uninterested in the project, 100% of the investors?
Yeah, I mean,
or buyers of the token.
Right, they just want to make money. I mean, I don't think they understand the technology, and I don't think they care. That's the more important one. I don't think they really care. I think all they care about is how soon will they be able to sell for a profit. And you can't actually publicly say that because then you'll be in violation of a lot of laws. So it kind of goes unsaid. I will give one decent example of what I think is an ICO and how I think is a good use case. I mean, the blockchain gives you the ability to do some censorship resistance, right? So the only decent use case I've seen for an ICO token, and I'm not saying it's a good investment, I'm just saying this is the only one that kind of got a slight pass from me, was when the BCAP token came out, which was a VC token. So every dollar of that token was backed by $1 investment of a VC company into other companies. So, I mean, you can debate and it was only 10% of the round. So a VC was raising $100 million, and they, got $90 million in traditional investment. They then decided, hey, for the rest of the 10 million that we're going to raise, let's do it as an ICO. Let's do it not even ICO. Let's do it as a token. So, but now non-US accredited investors, anybody can go ahead and buy this token, and it's worth $1 in our VC fund. And the only advantage that this token has is that it's now openly traded by people that want to take a part in that VC putting money into other companies. Now, I'm not saying that's a great investment. I think VCs lose money on average and not make money on average. But at least, that token doesn't have much speculative value because it's fully backed. Each token is fully backed by $1 investment of a VC into some companies. And the only thing that token does is provide a little liquidity so people can easily go in and out, and it can be more global, and it just has a little more access. But the token itself, I mean, they were starting to speculate on it a little bit, but people realized that it makes no sense. So that's the only model so far that I kind of saw as a use case for a blockchain in this space.
So I just wanted to clarify. So the point is you're saying that if you're an established company with revenue, the reason why you shouldn't do an ICO is 100% risk.
Yeah, it's whole risk.
Right, Bobby, Mikhail, do you have anything to add to it?
Yeah, actually, it's a very good point. The ICOs backed by VCs. It's a more stable coin. So this year, more and more existing businesses are going to launch ICO. Say it's asset-backed, so you're going to question how's the business of these companies at the moment, what's their cash flow, how their balance sheet looks like, how the P&L looks like. So we work with a number of companies right now rating their existing business, so it's not that easy. But at the same time, the guys, when you launch the ICO, you know, it's interesting to see how your performance is going to be. And this year we are launching a new product. We are working on the methodology. It's going to be a post-ICO rating. And more companies, they want to have that rating. Well, perhaps sometimes for the speculation, but they want to, when they want their token to be more stable.
I will play my own devil's advocate for a second, in the fact that when you see a company next to you that's doing the same thing you're doing, but they're able to raise $200 million with an ICO, and you know they're more incompetent than you, and you can only raise a measly 200,000, and they're raising 200 million with a completely a less competent team and a less competent product as your competitor, you have almost no choice but to follow this model and hope that everybody else follows it, and you're all in groupthink. And this is exactly how the dot-com bubble happened. This is exactly how the mortgage crisis happened, because you as an investor have no choice but to buy the unperforming collateralized mortgage obligations, because if you don't, your competitor will, and all of your clients are going to go to them. So you're going to go bankrupt earlier, but for a different reason. So you might as well join the party and also collect the millions. And so this is me playing my own devil's advocate as to why some of the companies will be ICOing when in reality they probably shouldn't.
Right, Bobby, do you have anything? Okay.
No, I totally agree on that, but you know, it all sounds like, guys, don't do any ICOs and don't invest in those. But yeah, it's the market right now. But I totally agree that that's the thing that's going to happen. But it's going to be traded. It's going to be traded for the speculation. So we'll see this year how it's going to play out.
Right, I think we have a little bit of time for another question.
One more.
Yeah.
Any questions?
One more question? No? Okay, then I'm going to ask you a question. What do you think the future of like crypto media and all the research and analytics will look like?
I think there's a strong demand for analytical media. Like it's kind of ridiculous how like everyone's buying into ICOs just by watching some YouTube video and like oh yeah, let's just buy this coin because some guy is saying this coin. It's funny how like one other metric that people look at in ICO these days is how many Telegram users are there, and people use that as like an indicator of whether to buy or not. As one of the many indicators. I speak to many investors as well. I mean, people look at Telegram, people listen to YouTube and all. So like, yeah, I mean, we may have a lot of things, but like, I think the market is really bubbly right now. So how long this will last, we don't know. Yeah.
I'll just make one other side note. So far, like I did explain the giant regulatory risk with this, but the other problem is the technological risk. Like, look, I know I'm taking a chance by having my money in Bitcoin, but I know the Bitcoin core developers. I've personally met dozens of them, and I know their qualifications, and I know what they stand for, and I know what they do. I can't say that about any other project, especially Ethereum. Like, no human is capable of downloading the entire Ethereum blockchain right now to validate every, historical transaction. That's it. It's over. Like, you can't. You're relying on other people that have them. They keep saying they're going to go proof of work after proof of stake after proof of work, but how do you show up at all your miners and tell them, hey, you're mining a block every 12 seconds, and I know each Ethereum is worth $1,000, but can you just guys stop? We just want to give all of this money to those that already have Ethereum. So you have no idea what the technological risks of Ethereum are, and everything is being built as an ERC20 on top of Ethereum. Who is actually if I ask any of the competent developers in the blockchain space, and most of whom I believe programming Bitcoin, about, and they're all like, they're not speaking publicly, but privately they know that Ethereum is not technologically sustainable. So you have a huge technological risk. And what are your terms and conditions look like for your ICO? I mean, even back in the 6 months ago, some of the bigger ICOs, when I was in their chat groups, I'm like, hey guys, what are you going to do with Ethereum forks again? And now there's a ETH for Ethereum and ETW for Ethereum work. Which chain you going to be on? And they're like, we haven't thought of that. I'm like, maybe you should. Something everybody should think about if they're going to do an ERC20. Ethereum is going to hard fork again, and both chains are going to be viable next time between proof of work and proof of stake. Which one are you going to trust?
So actually coming back on a question, the future of the research and how this analytics is going to play out, coming years. So Moody's, S&P, and Fitch exists. Well, S&P exists for almost 2 centuries already, and people gonna need the research. Of course, I agree, like these YouTubers promoting some, totally unqualified information, and kids are watching that, oh great, there is a new coin, it's gonna be pumped very, it's gonna be pumped, it can be pumped very soon. So it's totally unqualified information, but I'm 100% sure, even with the new regulations, new standards, people will need the research. People will need it as a basis, like a second opinion. Advisors come to us and say, "Oh, thank you so much. We can verify our judgment. We can, the second opinion is really good." Everyone probably knows the second opinion of your doctor. If you don't trust one, you'll go and check out another one. So the research is gonna stay.
Right, I'm afraid this is all the time they had, and I'd like to thank everyone for joining us.
I'm in the big room next in case anybody wants to go there.